Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. Okay, I'll start actually with the daily chart once again here, once back again here. And what a mess this chart is. However, you can see a whole lot of congestion and support levels below, especially going back from the end of February. And you can see some significant bands within that congestion, notably the 929 to 964 area, which is actually made up of two separate bands close together, the 939 to 949 band and the superior 957 to 964 congestion band. This latter one has the highs from middle and late 2012 within it. You can also see two other features. The 50% Fibonacci line of the 2022 move at 1024, as well as the upper time, currently 1056, of the well-broken mid-September 2021 to mid-January 2022 bullish Andrews pitchfork. Okay, why, may you ask, have I kept such a well-broken pitchfork on this chart? Well, as you can see from the market action over the last 2 weeks, we have seen the market pull back away from this upper time, back up and away from this upper time, and also upon approach to the 50% Fibonacci line. The problem is, I don't know just yet which one is the one that's responsible for that pullback, or if it is a combination of the two. However, I think that I'll be able to see which works, or if both do, as the upper time rises by about 11 cents a week away from the 50% Fibonacci line, and soon they will not be able to rely on each other. Okay, so looking once again at the longer term chart. As to get a better idea and better definition of what is going on, the first thing you can see is that superficially, whilst the market may look like it has a large rounded bottom originating from 2012, in fact it does not. Instead, we have a rounded bottom with only from 2018 to 2020, which had, prior to all the current volatility, already achieved its targets. But instead of the large rounded bottom expected here, we have a much more clearly defined 2014, not 2012, but 2014 to 2021 double bottom. So the 2014 to 21 double bottom had a primary target X in the 876 area. This was achieved in November last year, from which we saw a small pullback down to the 1 year moving average, currently at 777. It was only from there, the pullback, that we saw prices move significantly higher. It's only from the pullback that we saw higher through the 2014 high at 855, the 2012 high at 963, and a 2011 high at 1001, let's say. These three levels were the main resistances overhead until prices broke free higher, much as in early 2008, though not so far. Prices have not achieved those dizzy heights, despite there not being much in a way between 1001 and the 2008 high at 1394. Prices have instead stalled ahead of a potential target X1 in the 1340 area. Okay, so this is my taking a little bit of liberty with this market and calculating the size of the potential move higher as if the action from 2012 to 2021 was indeed a rounded bottom. A secondary target X2 thus would be in the 1485 area. Now, there is the possibility of looking at that period as a possible rounded bottom, but you would certainly need to use a bit of imagination to see it. This leads me to the twofold possibility of the 2018 today and the 2014 today actions being possible ascending scallop patterns. These two are still early on, and we would need to see if there is indeed hesitation, maybe around the previously mentioned highs or the recent 50% Fibonacci line in the 840 area. It would all depend if we see some consolidation in those two areas, along with a desire to move higher still. Minneapolis wheat. Okay, so a different timescale to all the previous markets I've previously covered. Here I can keep my normal daily chart instead of looking only or with a monthly chart to get some definition. Additionally, please ignore the different colors for the labels. There is no special significance in them. It's just my chart system playing silly buggers. The main move here happened on the 1st of March when the market broke clear of the prior mid-January to early March ascending wedge pattern. That started the move higher, quickly reaching its targets and disposing of such resistance as the July 2012 high at 1034, the May 2011 high at 1055, the May 2008 high at 1083, and the April 2008 high at 1166. Interestingly, the market peaked at the old gap left from the change back in March 2008 between 1208 and 1419. I guess that gap was just too much of a gap to fill in. Anyway, Tuesday, last week saw a daily key reversal down. That turned prices back down such that the market had dropped down to what I originally thought was a base on the 2022 50% Fibonacci line at 1042. But I suspect now that the market has been deciding whether to test it or not, that 50% Fibonacci line, and to see if the old upper trend line, currently at 1005, rising up to meet this 50% Fibonacci line, is a significant support. You can see this as the daily intraday indecision has now been running as of yesterday to the third countering level. Now the actions on this 50% Fibonacci line and the upper ascending wedge trend line are the immediate concern in this market. Meanwhile, all this action has allowed me to draw a fresh April 2021 to January 2022 bullish Andrews pitchfork. Currently the market's a little beneath the middle time, currently at 1109. This pitchfork has not been that good as support or resistance, but I'm hoping it may still provide the bullish angle of attack of this market. That is something we will have to see. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investors International Limited. And here comes the final bit.